Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden inside company filings and stick it to the stuffy accountants who try to bury them. Today we're looking at Applied Digital Corporation, and let's just say they've been busy securing some serious funding for their data center projects. Alright, so Applied Digital Corporation is making an official announcement on a big deal they've made. Think of this like a company saying, hey world, we just signed something really important that you need to know about. The main event here is a company called APLD FAR 01 LLC, which is a part of Applied Digital Corporation. This subsidiary is getting a pretty substantial loan. So Applied Digital, Tanker & Scene. The parent company is involved in a major financial move. They've got a subsidiary that's borrowing a lot of money to build out their big data center campuses. This is basically a formal promise to pay back money. It's the actual document outlining the loan agreement. The company getting the loan is APLD FAR 01 LLC, and the one lending the money is Macquarie Equipment Capital. That's a big finance company, so they know what they're doing. The loan starts with a cool $50 million right off the bat. That's a lot of cash to build stuff. And it's not just that 50 million. They can actually borrow another 25 million if both sides agree. So this is a $75 million potential deal. That's a massive infusion of capital. Now, how much does this loan cost? It's 8% interest per year. That's pretty standard for this kind of deal, but there's a catch. If something goes wrong, if they miss payments or break other rules, the interest jumps up dramatically. It becomes 8% plus an extra 1.5% each month. That's a huge penalty. We're talking about going from normal interest to sky-high interest very quickly. For the first year, they don't have to pay this interest in cash. Instead, the interest gets added back to the loan amount. This is called payment in kind, or PK. It means the debt grows even before they start paying it back with cash. It's like letting the debt compound on itself. The loan has a few deadlines that could make it due sooner. One is if something called the 200 megawatt lease execution doesn't happen by the end of October 2025. If that doesn't happen, the loan is due February 1, 2000 set. That's a tight timeline. Otherwise, the loan is due in September 2027, so they have about 3 years to make this work. A big trigger for having to pay the loan back immediately is a change of control. If the company gets bought out or its ownership changes significantly, the loan could come due right away. And here's an interesting part about paying the loan back early. If they want to pay back any of the loan before it's due, they have to make sure the lender gets back at least $110 for every dollar they pay back. This is a way to make sure the lender always makes a profit, even if the loan is paid back ahead of schedule. It's like a prepayment penalty that ensures a certain return. So what's all this money for? A big chunk of it is for building out their data center campus in North Dakota. Specifically, they call it Polaris Forge 2. They're buying the land, paying for all the closing costs, legal fees, and also buying special equipment like transformers to power these new facilities. To secure this loan, not just the borrowing company, but also its parent company and another related subsidiary are putting up their assets as collateral. That means if they can't pay, the lender can take their stuff. This shows how serious they are about getting this funding and how much they believe in this project. The parent company, Applied Digital Corporation itself, is also backing this loan with what they call a parent guarantee. This means they're on the hook if the subsidiary can't pay. This guarantee also has some strings attached, like limits on selling assets or taking on new debt without the lender's okay. It's also worth noting who helped put this deal together. Northland Capital Markets was the main person helping them find the money. Wells Fargo Securities and Texas Capital also advised them. These are financial professionals who know how to structure these big deals. Now, switching gears a bit, there's another important update. They've also made changes to a preferred stock offering. On September 11th, they updated an agreement related to selling what's called Series G preferred stock. They've increased the total amount they plan to raise from this preferred stock sale. It went from $300 million to $450 million increase in their fundraising goal. This is to help pay for their other data center project, Polaris Forge 1, and for general company operations. So they're not just building one new data center, they're building two, and they need a lot of money to get them done. This new stock offering will fund the continued construction and development of that Polaris Forge 1 campus. This isn't just any stock, it's convertible preferred stock. That means it's a special type of stock that usually pays a fixed dividend, and it can be converted into regular common stock later on. They're authorized to issue up to 24,000 shares of this series preferred stock. They are doing this stock sale without registering it with the government. They are relying on an exemption from registration that's usually for private sales to sophisticated investors. This means they're not selling this to the general public directly through a stock exchange in this case. Another bit of paperwork they filed is an amendment to their official document that describes the Series G preferred stock. This is just formalizing the changes they made to the number of shares they can issue. This just confirms that they've increased the number of preferred shares they are allowed to sell, going from 156,000 to 204,000 shares. It's all tied to that bigger fundraising goal. This whole section is a big disclaimer. Companies put this in to say that when they talk about the future, it's just their best guess and things could change. They're basically saying, don't sue us if our predictions don't come true. It covers things like future operating performance, product development, and financing plans. They use words like will and expect, but remind us that these are not guaranteed. This is a really important risk they point out. They need to keep raising money to build and run these data centers. If they can't get the cash they need on good terms, or even at all, that's a major problem for their plans. They also mention they rely heavily on a few big customers, and if they can't fulfill their agreements with these customers, like the ones with CoreWeave, that's a big risk. Their business depends on keeping these major clients happy and operational. This is basically an index of all the other documents attached to this report. It lists all the details and agreements that back up everything they've said. This refers to the amendment for the Series G preferred stock. This is the actual promissory note we talked about earlier, the big loan document. This is the parent guarantee, where Applied Digital Corporation promises to pay the loan if the subsidiary can't. This is the guarantee and collateral agreement, which lists all the assets that are being pledged as security for the loan. And this is the form of the second amendment to the Preferred Equity Purchase Agreement, which is the document that allowed them to increase the amount of Series G preferred stock they could sell. Alright, let's talk about what all this means. Applied Digital is going all in on building data centers specifically for high performance computing, which basically means powerful computers used for AI and other demanding tasks. They've secured a pretty big loan of up to $75 million, and they've also significantly boosted their preferred stock offering to $45 million. This shows a lot of ambition. The good news is they're getting the funding they need to expand. The big concern is the sheer amount of debt and the reliance on future fundraising. That 8% loan with a potential 1.5% monthly penalty is a big deal, and the quick deadlines if certain partnerships or deals don't happen can put a lot of pressure on them. Plus, having to give the lender a 1.110 return even on early payments is a sign they're paying a premium for this capital. Their strategy to fund these massive data center projects through a mix of loans and stock sales is pretty standard. But the scale is what's important here. If they can execute their build-out plans, secure those key customer leases, and manage their debt, they could be in a very strong position. However, the risks they themselves highlight, like having to constantly raise capital and relying on major customers, are real. If demand for these specialized data centers slows down, or if they can't lock in customary raised capital and relying on major customers, are real. If demand for these specialized data centers slows down, or if they can't lock in customers from companies like CoreWeave, they could be in a tough spot. In my opinion, Applied Digital is playing a high-stakes game. They're betting big on the continued growth of AI and intensive computing. They've managed to get the money for now, which is a win, but the pressure is on to deliver on their projects and keep those revenue streams flowing to service all this debt. It's a classic growth story, but with growth comes significant risk. Alright, that's our breakdown of Applied Digital's latest financial maneuvers. What's your take on these numbers and what they signal for the company's future? Does this aggressive expansion strategy excite you or make you nervous? Drop your thoughts in the comments below. If this deep dive was valuable for you, hitting that like button really helps us out. And of course, subscribe for more corporate decoding sessions. Don't forget to join our Discord community too. The link is in the description. Thanks for watching, and we see you in the next one.